Okay, so picking back up from where we left off, again, uh, I think it's helpful to think about these topics from and use the audit risk model as the um, framework for how we think about these things. So the audit risk is a function of inherent risk, control risk, and detection risk. And so I'm pairing learning objective 2 with audit risk because we need to think about the assertions and make sure that we can cover those. And so, um, again, we have these six assertions and how they, so the six assertions would be existence, completeness, cutoff, rights and obligations, valuation, and accuracy. We kind of lump together. And then we have a presentation disclosure, right? So those are the six assertions. And then how they relate to, let's see if I can get rid of that thing, how they relate to the transaction cycle is what makes it an audit objective, right? And so here, existence of inventories and the occurrence of transactions affecting cost of goods sold, right? That's the audit objective to make sure we feel good about that. Establishing that inventories are complete, right, in terms of what's recorded is complete. That's the audit objective. Verifying cutoff for cost of goods sold transactions, right, that's the audit objective. Determine that the client has the rights to the recorded inventories, right, that's the audit objective. Establishing the proper valuation of inventories and the accuracy of cost of goods sold transactions. And then lastly, looking at specific presentation disclosure items related to inventories and cost of goods sold. So those would be classification of inventories, accounting methods used, and then looking at any um, collateral, inventories pledged as collateral. Okay, so let's see, I think I can clear that. Um, oh, where is it? There it is. Sorry. And so when we look at the next learning objective uh, that I'm going to focus on is well, the next component of the audit risk model is inherent risk. So I'm going to focus on the learning objective that I pair with that, which is learning objective 4. And so looking at learning objective 4, we need to understand the client's business, right? And specifically related to this inventory transaction cycle. So what kind of products are they acquiring? What kind of labor are they acquiring? If um, is this a manufacturing company or not? Is it retail? What are they actually doing? What's their conversion process actually composed of? And all firms have a conversion process, by the way, right? Doesn't matter if you're a retailer, even a service firm. So think about an accounting firm. They have a conversion process. They acquire inputs. In this case, it's labor. There is some supplies and some uh, product, or excuse me, hardware that they need, for example. So you go work for an accounting firm, you're going to get a computer. Um, they have, a lot of tools that they're going to provide you with, a lot of software they're going to either purchase or acquire. But then how they take all that, put it together, and then provide a service that they can sell, right? That whole process is conversion, right? The training you get at an accounting firm, that's conversion. So understanding that, understanding what your client actually does to convert its inputs into an output that they can sell, right? That's this learning objective. That's understanding the client's business. So we need to understand their suppliers, need to understand seasonality, need to understand typical contract terms, need to understand policies around pricing of inventory, of purchase discounts, payment terms, those kinds of things. To what extent, if they are a manufacturer, are they manufacturing all the product versus having other firms that they use in acquiring their parts? Um, and then thinking about inventory and costing methods that are typical for the industry, right? And then that way you could be able to compare it against the firm, your client. So that's all used to help assess inherent risk. The control risk, and along with a lot of other things, right, in terms of the age of the firm and uh, the riskiness of the product or the competitiveness of the industry, all those things that we've talked about before, but I just wanted to focus on the things that were unique to inventory. Looking at control risk, again, I'm pairing these two learning objectives together. One is kind of you as a student understanding the process, the transaction cycle, and the controls, and then learning objective 5 is kind of specifically how would the auditors go about obtaining an understanding of the internal controls. So learning objective 3 is largely a review of what you learned in the AIS class in terms of uh, how that process worked. Having a purchasing, having receiving, in this case storing if we have a manufacturing company, issuing products, the whole production process itself, and shipping, right? These are all things that could be related to inventories. I'm not going to spend a lot of time talking about these functions beyond just noting a couple things, right? Usually you're going to have a purchase requisition that request that the firm go out and acquire goods, whether it's goods to sell or goods to use. A purchase order is often used. Um, receiving, you're receiving the goods in that you ordered, making sure things haven't been damaged, making sure the quantity's there, receiving reports. Um, if you have a storing function, then they're going to actually secure the inventory. Um, and if a department requests to use the items, then that storing department, storekeeping, whatever name you want to put on it, will provide those items. Then obviously production is where the goods are produced, and then obviously shipping based on a sales order. Okay, what is a little different is, well, you probably talked about this, but maybe not in the business process context in terms of cost accounting. They basically are trying to determine how um, raw materials are used and then how finished goods are determined, right? And also work in process. And different firms may break this up in different ways, but that's one way to do it. Um, obviously, there's some wrinkles here in terms of whether you're using perpetual or periodic inventory. But let's focus on the internal controls for a couple minutes, since depending on how much you talked about this in AIS, you may or may not have hit that as much. But internal control, we're going to use the COSO framework again. And so when you think about the control environment, specifically for inventory, then you're looking at, okay, how qualified are the individuals that are involved with inventory, right? So the purchasing department, storekeeping, production, looking at the quality of the individuals in terms of their qualifications and training. Obviously, integrity is important. One of the common frauds for a purchasing agent is if they accept kickbacks on purchases they make. So, for example, they may purchase from a supplier that says, "Hey, we'll give you, you know, either cash or we'll give you tickets to the game or whatever if you can hook us up," right? And so the firm needs to have a good process in place to make sure that they're encouraging purchasing agents not to take any form of kickback for any orders that they may make. And then how we're actually structuring the organization, all that is part of the control environment. For risk assessment, then we're going to be looking at, okay, um, how scarce of a supply do we have for our raw materials? Are there a lot of suppliers out there, for example? Is it a very competitive industry, or is it a monopoly where if one vendor had a problem, that'd be a big issue with acquiring some of our raw materials? Um, how stable are the prices? And are we going to have changes to technology that impact this process, right? Either impact what we do or impact how raw materials are produced or acquired, those types of things. How likely is it we're going to have obsolescence of our inventory, whether it's inventory that spoils or whether it's technological obsolescence of inventory no longer being relevant. Another internal control component is monitoring, and so that would be how well is how well the internal controls being followed, and so we might look at production supervisors, um, Might do quality assurance, where we're trying to actually test the quality of our, or excuse me, where the client is trying to test the quality of the products before they ship them out, right? That'd be part of monitoring. And then obviously thinking about improvements. All right, so one thing that we're going to do um, as an application is to look at the internal control, identifying internal control strengths for, we're going to use a process you're familiar with, which is the SUA, and we're going to look at trying to identify physical control activities based on the COSO framework, um, and looking at those 6 areas of physical control activities. We did this for revenue as well. Keep it in mind, remember, it's really hard to see supervision, and it's really hard to see access controls on a flow chart. But that's what we're going to end up doing for our application.